When it comes to investing in the stock market, growth stocks are highly desired by investors who seek to increase their wealth exponentially while taking on some calculated risks. These stocks with moderate to high volatility, if selected carefully, tend to outperform the broader stock market, as their underlying company focuses on revenue growth and enhancement to profit margins. In this video, we'll take a look at 3 such high growth stocks on the TSX that have the potential to generate market-beating returns over the next decade and potentially triple your investments. And these are 3 very unique companies. The first one is a health tech Canadian company with a staggering 300% gain so far this year in 2020 and a massive 5,500 plus return since its IPO back in April of 2016. The second stock we'll review would be intriguing to those of you who are bullish about electric vehicles. This Canadian EV company has shown an astounding 600% return in the stock market so far this year. And lastly, our third high growth stock to review is a Canadian ride-hailing company with its stock surging over 500% since its IPO last year. But before we get into this video, please take a moment to subscribe to the channel and hit the like button to help with YouTube algorithm. This really supports the channel to grow and means a lot to us as we've put a lot of time and effort to make this video for you. The first high-growth Canadian stock to review is WELL Health Technologies, with the ticker symbol WELL, traded on Toronto Stock Exchange. The stock is last trading at $6.55 Canadian dollars. It has gained a massive 300% plus in 2020 and close to a staggering 5,800% gain since its IPO in April 2016. This means that a $1,000 investment in the WELL Health IPO would have ballooned to over $58,000 today. WELL is an omni-channel digital health company whose overarching objective is to empower doctors to provide the best and most advanced care possible while leveraging the latest technology and trends in digital health. As such, WELL owns and operates 20 primary healthcare medical clinics and is Canada's third largest electronic medical records supplier, serving over 2,000 medical clinics. WELL also operates a leading national telehealth service and is a provider of digital health technology solutions. The company is an acquisitive company that has completed 12 acquisitions and 3 equity investments. What's more, it is a majority stakeholder in companies such as Sleepworks and Spring Medical. This software-as-a-service-based company launched its telehealth service in March 2020 that connects patients and physicians via video, messaging, and phone. WELL Health aims to consolidate and modernize healthcare assets by leveraging digital technologies and processes, which should improve operational efficiency for healthcare providers and enable them to provide a satisfying patient experience. While healthcare in Canada is very accessible and affordable, and government is investing heavily in the healthcare sector, the Canadian primary healthcare system is lagging behind from a digitization perspective, and the wait times for patients can be extensive. With Canadian government investment in healthcare growing each year, there is a huge opportunity for health tech companies to capitalize on this field and work towards addressing the healthcare challenges through modernizing services. WELL Health Technologies is well positioned to benefit from this growing market. The company is currently the owner and operator of the largest single chain network of primary care clinics in British Columbia. Additionally, they provide electronic medical record services that support hundreds of medical clinics, thousands of doctors, and millions of patients. As both a clinic operator and technology developer, WELL has recently announced its plan to expand into US market with a proposed majority stake in the Silicon Valley-based telehealth leader Circle Medical. Circle Medical is a national US telehealth provider who has delivered virtual primary healthcare services in 35 states over the past recent months and plans to extend its telehealth services to the majority of the remaining states in the US within the next few months. Circle Medical also owns and operates 2 California-based brick-and-mortar clinics. The second high-growth stock to review is a Canadian electric vehicle manufacturer called Green Power Motor, traded on the TSX Venture Exchange with the ticker symbol GPV. If you're bullish on electric vehicle companies, then you can look to invest in Green Power, which is the only publicly traded EV manufacturer in North America after Tesla. Green Power stock is last trading at $15.21, which indicates year-to-date gains of over 600%. However, the stock is also trading 47% below its record high, which provides an attractive buying opportunity. This company is currently valued at a market cap of $277 million. Green Power has completed the delivery of 68 buses and generated $13.5 million in sales in its fiscal 2020 that ended in March. Analysts expect the sales to touch $51 million by fiscal 2022, indicating a forward price to sales multiple of 5.3, which is very reasonable given its robust growth rates. Green Power is also expected to improve its earnings per share from negative 34 cents in fiscal 2020 to a positive 21 cents in fiscal 2022. Green Power Motor designs, manufactures, and distributes zero-emission EVs that cover the local cargo, delivery market, and school sectors. The company's presentation states that the number of battery-powered medium and heavy-duty commercial vehicles sold in the US are expected to grow from 1,600 in 2020 to 50,000 in 2025 and 912,000 in 2040. Green Power Motor is well diversified and expects demand from universities, airports, van pooling, and transit authorities that have already purchased multiple vehicles. The final company on the list of Canadian high-growth stocks is a Canadian ride-hailing company called FaceDrive, which is eyeing rapid expansion. FaceDrive is already valued at a market cap of $1.12 billion and has surged almost 500% since its IPO last year. The FaceDrive stock, which is traded at TSX Venture Exchange with a ticker symbol FD, is last traded at $12.06 Canadian dollars, which shows a year-to-date gain of over 400%. However, the stock is also trading below its record high and has a 132% upside if it were to reach its all-time high price of $28. This provides an attractive buying opportunity for FaceDrive stock. FaceDrive is the first Canadian peer-to-peer ride-sharing company that currently operates in the Greater Toronto, Hamilton, London, Ontario, and Guelph. In its first quarter, FaceDrive sales surged by a massive 1,000% to reach $388,000, which is why it can support its sky-high valuation. However, the company is still tiny compared to ride-hailing giants such as Uber and Lyft. FaceDrive will have to keep growing at a breathtaking pace and will also burn millions of dollars before it becomes profitable. The company has a cash balance of $3.4 million, but investors should brace for multiple capital raising rounds given the negative profit margins for the companies in this space. FaceDrive is also looking to expand into other Canadian markets as well as in the US and Europe, which will result in exponential revenue growth for them. Furthermore, it is targeting food delivery, healthcare delivery, and e-commerce as alternative sources of income to diversify its business. According to the news, and most recently, the HiQ app by HiRideshare, which is a wholly owned subsidiary of FaceDrive, has surpassed 1.5 million downloads. HiQ is a socialization platform that invites users to stay connected safely and encourages interactions based on common interests. FaceDrive's mission is to help its users make simple, day-to-day decisions that will contribute to a healthier planet. FaceDrive is changing the ride-sharing, food delivery, e-commerce, and health tech narrative for the better for everyone. They offer socially responsible services to local communities with a strong commitment to doing business fairly, equitably, and sustainably. Keep in mind that the 3 Canadian high-growth stocks we discussed today are based on the market research and for entertainment, and you have to do your own due diligence before buying these or any other stock. That said, personally, I'm interested in these 3 companies and would most likely start a small position in them in the weeks ahead and would grow my position over time. Given the relatively smaller size of these companies compared to their counterparts in the US, there lies a huge opportunity for them for exponential growth. Just to give you an idea how lucrative investing in high growth stocks can be, if you were to invest $1,000 in each of these 3 stocks we discussed today at the start of 2020, it would have returned a cumulative $16,000 in fewer than 9 months. Not bad, eh? Thank you so much guys for watching this video. Are you invested in any of these stocks? Do let us know in the comment section down below. Hope you found this video beneficial and you learned something of value from it. If you did, please be sure to give it a thumbs up and share it with someone who might benefit from it as well. And don't forget to subscribe to Momentum channel. Here on Momentum channel, we post weekly videos about stock market investing and finances. Hope to see you next time.